concepts may be useful for you. So that way we consider the discussion today. So we'll be discussing many things today. Quickly, I'll tell you the concepts. If you understand, it's well and good. I'll be using the Excel file that I have discussed in the previous class. Previous class means in the other section. Okay. So as Aliva told, so standard deviation, variance, beta, through all those things, you find out the risk of an equity investment or any kind of investment. Now, so what do you consider here? Individual equity price movement. And again, benchmark you used. In case of beta, you use the benchmark to find out what kind of risk is involved. Now, anybody can tell me, you have measured the risk, but how can you reduce the risk?
So by diversifying the portfolio.
By diversifying the portfolio. What do you mean by the portfolio?
The portfolio is the different stocks, the pool of stocks which we have
Okay,
invested.
good, Sriya. Let me give one CP mark to Sriya. Sriya Sarkar, 1 minute. So you can diversify to reduce the how. Sriya, just further explain how you can reduce the risk by diversifying.
So we can see the risk appetite. We can hedge our portfolio by investing in gold
And
also.
that's fine, but what I am asking you, suppose you diversify, how can you reduce the risk?
So different.
You see, what I'm telling you, you go into the details. How you can reduce the risk? I diversify the risk portfolio. So you see, okay, I'm answering. I'm telling you. Abhik is telling something. Abhik, tell.
Sir, we have to go into a details. If a company has different sectors, we have to go sector wise. That if the entire company is not taking the loss, the part which is making the loss, if we can reduce that section, then in that way we can do something about the risk.
So you see, in simple terms, if one stock is making loss, another stock will make profit. So in the process, you get a moderate profit. May not be very high profit you are getting, but moderate profit with lesser risk. So that is our expectation. We should think of reducing the risk. So risk minimization is the primary focus of our investment, and it is a portfolio. So what is a portfolio? Portfolio may be, as Sriya told, may be different shares. That is one. It may be different avenues of investment like equity, debt, fixed deposit, many things. Okay. So that way also you can define your equity, your portfolio. And portfolio may be stock of different countries. That may be also a portfolio with different parameters. Example, suppose we are talking of IT sector. So you may be buying Infosys, TCS, which are in large cap. You may also think of companies like your Happiest Mind, Mindtree, which are in the mid cap. So that is also a portfolio. Are you getting me? Maybe different sectors. You may think of FMCG sector. You may be thinking of your real estate, capital goods. So that way also you can define your portfolio. Okay. Are you getting me? So different way you can create your portfolio. So here we are talking of portfolio of different shares. Portfolio of different shares we are discussing. So now what will be can that portfolio also have a risk? Portfolio may also be having a risk. So how do you measure the risk of a portfolio? That we'll discuss today. How do you measure? So you see, I'm just giving you the broader view of everything. Suppose, let us see this real life situation. I am investing 10 lakhs. 10 lakh rupees I have in my hand. I am putting 3 lakh in BEL. Okay. Another 3 lakh in Tata Power. Another 4 lakh in Voltas. How much total value? It is 10 lakhs. Okay. Now, what you can do to reduce your risk? You may change the proportion. Like one share you can make more, another share you can make less. So how do you decide it? Once you determine what is the a specific kind of structure, like this 3, 3, 4, it is one pattern. In this pattern, what kind of risk involved you can measure, then you can think of some other alternatives. Correct? That is the way you should approach it. Then the first and foremost thing is Sharpe ratio through which you measure the risk of a portfolio. So it is defined as risk return of a portfolio minus return of into your risk-free investment divided by standard deviation of portfolio. This is the formula through which you can find out the risk. So can you comprehend how do you do it? Are you getting me?
Sir, can you please repeat the formula? Risk of portfolio minus
risk of portfolio minus risk-free return. This is return of portfolio, or let us put it this way. This is portfolio return minus risk-free return divided by standard deviation of portfolio. Okay. So now how do you find it out? Risk of return of portfolio you can comfortably find out. So we have already discussed in the last class that share price movement is defining the return involved with the individual stock. Suppose I have got 5 stocks. In stock 1, I have 300 rupees was my share price. Now, after 1 year, it has gone up to 325. Then what will be my return? My return will be 325 minus 300 divided by 300. Like that, you can find out the return of all individual stocks. Getting it or not?
Yes, sir.
Yes.
So that way you can find out the and risk-free return, you know, RBI bond rate or something will take, maybe suppose 8.5% or 7.5%, like that. You have taken a return. Then standard deviation of portfolio, how you can find out? So here again, price movement of individual stocks you will find out, and then club it up on the basis of the proportion of stocks. Here suppose the proportion is 3/10, 3/10, and 4/10. So 0.3, 0.3, and 0.4. That is the proportion of 3 stocks here. So likewise, you can find out the standard deviation of portfolio. Once you find out individual standard deviation, multiplied with the proportion, then you can find out. Are you getting me? So yes, tell. Are you talking of capital asset pricing model? Capital asset pricing model can be used for this thing, but today I am explaining you something beyond this thing. So 3 tools primarily we'll be discussing today. So first one is the Sharpe ratio. Could you understand how do you find out? Return of portfolio minus risk-free return divided by standard deviation of portfolio. That will give you the Sharpe ratio. Now you see action point, how do you do? So once you find out Sharpe ratio of a specific pattern, pattern means what does it mean? Pattern means a specific proportion of shares in 5 stocks, say 5, 4, whatever you are taking, 20, 30, whatever number of stocks you are taking. Once you find out specific proportion, then you find out the Sharpe ratio. What you will do? you can decide on this thing, what kind of risk is involved. Then you can think of some other combination. So like that, you will have to proceed to minimize your risk. Could you get it? First of all, till now, to summarize the whole thing, let me tell you again. First of all, you have discussed the individual risk associated with stock. That may be coming through standard deviation, variance, probabilistic return, and beta. To minimize a risk of your investment, you will have to diversify it. Diversification or combination of few shares. Diversification means investing in more than one stock or more than one investment avenue. So that combination is called a portfolio. So you will have to build a portfolio to reduce your risk. But portfolio also may be having some risk. So first method of calculating the portfolio risk is the Sharpe ratio. Sharpe ratio you can find out by the formula of return of portfolio minus risk-free return divided by standard deviation of portfolio. Okay. So you see, just conceptually, I'm explaining those things. We are not going into detail and formula because in SAPM you will be studying in detail. The next is another tool which is called value at risk. What does it tell? You see, you have got different methods of calculating value at risk. So as you are telling, SAPM model may be used, or normal distribution curve may be used, or your Monte Carlo simulation may be used. But how it is expressed, let us see. Usually who uses this tool? So value at risk is primarily used by your fund managers and bankers. Why they use value at risk? Because their investment is huge. So a systematic approach of analyzing the risk is important. So that's why they usually use the value at risk concept. So how do we express value at risk? A probability of getting a specific return from a portfolio. It is called value at risk. So suppose I write like this. There is a 5% probability of getting 25% return from the stock or from a portfolio. That will explain your value at risk. So concept wise, you see normal distribution curve, you know, in statistics, you put it like this. You have got outer layers at 1% level, 5% level, and 10% level. So you can always see that avoid this your portfolio. You see, once you have different combination of portfolio, you can put those combinations here and their return versus risk. Like this, you can put inside the curve. Whichever are the outliers, you can always avoid them and focus on the portfolio combination which is inside the normal distribution curve. That way you can proceed also. So this is one way of calculating. Monte Carlo simulation, how it is done? You see, as I was discussing, you have got one combination, suppose 3 lakh, 2 lakh and 5 lakh, 10 lakh combination with BEL, Tata Motors and Voltas. Then 3 lakh, 1 lakh and 6 lakh, 10 lakh is another combination. 3 lakh, 4 lakh and 3 lakh. This is another combination. 2 lakh, 4 lakh and 4 lakh. Again another. You see, my investment is everywhere, it is 10 lakh. Can anybody tell how many combinations you can have?
4 combinations.
4. 4 I wrote here. But there can be many things. You keep one constant and change the other one. Change the all 3. Several combinations are possible. You see your permutation combination formula are there. Through that you can find out how many combinations, huge number of combinations may be possible. But remember, my stocks already, my portfolio will not be 3 stocks. It may be 20 stocks, 50 stocks. So you know your reputed investors, whoever the big bulls you are telling in India, they must be having 30 to 70 stocks in their portfolio. So in order to find out a proper combination, you can have different kind of combinations, then find out which one has the higher or lower risk. So how do you do it? It is done through a computer programming, which is called a Monte Carlo simulation. So you remember, in manually Monte Carlo simulation, you cannot do. So through iterative process, this can be done through Monte Carlo simulation. So usually your investors or the financial institutions, they have got combination ranging from 1,000 to 10,000. That many combinations are possible, and they try it to find out the best possible combination. Could you understand this thing?
Yes, sir. Yes, sir.
So we are talking up three things. First, we discussed about Sharpe ratio. You will all those things you will be studying in SAPM in detail. That's why I'm not deliberating it extensively. That is one. Second, also you don't have too much of time to again go into detail. So first one is portfolio risk is important. It is important to measure it and also take proper action against it. So portfolio risk, how do you measure? You measure through three methods. One is Monte Carlo simulation or normal distribution, which we are considering for your value at risk. Value at risk has three methods. I think CAPM model and normal distribution curve, and another one is there. I think this one is also Monte Carlo simulation is also there. So through those methods, you can find out what amount of risk is involved in individual stock. After you have found out, you can have a right kind of combination which will provide the lowest risk. Could you get it? The concept portfolio risk, could you get? Even in interview, if somebody is asking what is Sharpe ratio, what is Monte Carlo simulation, what is value at risk, when you explain, you can always tell there is a specific level of probability to get a specific level of return. That explains the value at risk. It may be for a stock, it may be for a portfolio. Is it done?
Yes, sir.
Can I proceed to the next one? Some 3, 4 should 4, 5 should tell yes, then I will proceed.
Yes, sir.
Yes, sir.
Okay, yes, fine. Sir. Okay, thank you. So here our portion of risk is over. Then anybody can tell me what is the meaning of literal meaning of your liver? What is the meaning of a liver? Nobody? Literature. No? Nobody knows what is the meaning? Liver is a software company. No, I am telling you what is the meaning of this word. As honesty, you know, the meaning is somebody who is genuine and speaks the truth. What is the meaning of liver?
Sir, rigid bar resting on a pivot.
So primarily you see it is a balance. Liver means balance. So you know, Kanun Andha hai, that picture in the court you must have seen. There is two sides of a balance, both are equal. So one lady will be holding it, both sides are equal. That means we don't give partial to anybody. So in this case, what is the liver? So you have got two sides. One side in operating leverage, we tell it fixed cost versus variable cost. Okay. This concept is called, this trade-off is called operating leverage. Another one is debt versus equity. This trade-off is called financial leverage. Could you get it? That means how much you have. you see, although its meaning is it is balanced. So, but in company, can you do it like that? Fixed cost and variable cost same. It is not possible. So you will have to see in this balance, which side you will put more weightage to which side. That is the basic meaning of leverage. Leverage means finding out a proper trade-off between fixed cost and variable cost or debt to equity. When it is fixed cost and variable cost, you tell it operating leverage. When you tell it debt to equity, it is called financial leverage. Got it? Got it or not?
Yes, sir.
Yes, sir.
Okay. So let us discuss your operating leverage. So you know in your cost accounting you have studied that sales will be the combination of fixed cost plus variable cost plus profit.
Yes.
You have studied or not? And when your
Yes, sir.
fixed cost, your fixed cost plus variable cost is equal to sales, what you tell it?
Sales minus profit.
Now what you tell it? Fixed cost plus profit, that is equal to sales. In this situation, what is the situation?
Break-even point, sir.
Yes, it is a break-even point. Who told?
Me, sir.
Asker.
No, sir, me. You ask Aliba, sir. You ask Aliba.
Abik, okay. Abik, okay, fine. So, fixed cost plus variable cost, that is, if sales, that is break-even point. But you are not here to make break-even only, you will have to make profit also. True or not?
Yes,
Now,
sir.
if the same equation we put it this way, fixed cost plus profit, that is sales minus variable cost, you can put it like that. You see, this equation I am only changing little bit. Sales minus variable cost. Variable cost comes this side. That is fixed cost plus profit. Yes or no?
Yes, sir.
Yes, sir.
So I think this also Saroj sir already would have taught you. This is called, what this is called? Both the parts. These are this.
Contribution.
Contribution. Good. Contribution. Good. At least somebody is studying properly. So this is called contribution. Now, what I'll have to see, if I increase the number of units. Now, another thing I'll tell you. Now tell me variable cost per unit is constant or variable? Fixed cost per unit, constant or variable? Sales
Constant.
per unit, constant or variable? All are wrong. Variable cost per unit is
Constant.
Fixed cost per unit is variable.
Variable.
Sales price per unit is constant. Other way around, suppose we tell in totality, variable cost changes total. Getting or not? If you tell the total figure, variable cost changes, sales value changes, but fixed cost is constant. True or not?
Yes, sir.
So what your basic postulation, what does it tell? It tells that which cost I'll have to manage. more efficiently?
Variable cost.
Variable cost, sir.
How?
The fixed cost will be fixed anyway because of the capacity, depending on the capacity, but variable cost will vary na. So we can control that cost to minimize our cost.
Let me tell you one thing. How it is easy to control variable cost you are telling, or how it is important to control variable cost. I have 2 lakh units of production. Okay. Variable cost per unit is 3 rupees. Sales price per unit is say 5 rupees. Okay. My fixed cost is say 80,000. How much is the fixed cost per unit here? Tell. 2 lakh units I am producing. 3 rupees is variable cost per unit. 5 rupees is sales price per unit. How much is the fixed cost? Because in totality we'll have to explain 80,000. How much is per unit?
2.5.
0.4.
0.4, sir. Yes, sir.
Now, suppose I produce 4 lakh units. Tell me, my sales price will be 5 rupees. Variable cost will be 3 rupees per unit. My fixed cost per unit will be how much?
0.2, sir.
4 lakh. How much it is? 0.2. Now tell me, where you have got scope for control? It remains same. So if I produce more, I can absorb my fixed cost better.
Yes, sir.
Per
Economies
unit
of
cost will
scale.
go down. Per unit cost will go down. Who was telling? Aliva or somebody was telling that we should focus more on variable cost. Now you understand why we should focus more on fixed cost?
Yes,
Don't
sir.
look into even if you don't look into the per unit cost of variable, you can comfortably reduce the cost or increase the profit by managing the fixed cost. Correct. So our focus is to manage the fixed cost. So that's why you see this leverage is primarily talking of how many units you should produce. You see, again here the issue is not necessarily that you can increase the units as much as possible. You will have to also see that how much units will sell. True or not? What kind of price you command? That is also important. Getting or not? What I am trying to say, more number of units if I produce, I absorb my fixed cost better. Per unit cost reduces. But that is not always possible because there are other issues. If I keep on producing higher number of units, I may not sell. The whole amount will be lost if I cannot sell. Okay. Moreover, if my sales price reduces, if my units are more, that is also may not be viable. So what I'll have to do? I'll have to know that if I have a base information that how I have absorbed my fixed cost, then this will tell that what kind of decision I can take on my sales price and my number of units produced. Could you get it? What for we are discussing operating leverage? You are discussing operating leverage to see that what level, optimum level you can produce considering the sales price and your number of units produced and also variable cost. Variable cost as such will not be changing. Are you getting me? So this provides a background information. The level of number of units you should produce in the organization. Got it? Tell yes or no.
Yes, sir.
So my operating leverage is explained through this formula. Let me go this side. It is contribution by profit is my operating leverage. Contribution by profit. So you see, this is one way of explaining. You see, this is an absolute figure which will tell you at this level you are operating. Okay, looking into this thing, then you decide what should be your sales price, how many number of units you should produce. Okay. Beyond that also, there is a degree in change of operating leverage. From one stage to other, you are changing, what kind of change you are expecting. That is also an important parameter. So that is explained through change in profit by change in sales. How much profit you are, how much income, more income is coming to you by changing the number of units you are producing. Got it?
Yes.
Anybody can summarize operating leverage? Come on. Nobody? Now, what is the purpose?
Sir,
Let
by
me ask
operating leverage, sir, by doing operating leverage, we get to know what is the optimal number of production we should be producing to get the minimum fixed cost per unit, so that
Yes.
the cost is minimum.
Okay. So operating leverage is a background information which provides a clue. Okay, price can go up to this level. Okay, your sales price, or sorry, your sales volume can go up to this level. Number of units produced can go up to this level. So this provides a background information for this thing. Okay. Change in operating leverage is change in income by change in sales, or change in profit by change in sales. What does this tell? This tells that among two situations, what kind of difference I am experiencing. Okay. Then next I am going to financial leverage. So you know two things, simple things. It is debt plus equity that makes the total capital. Then proportion of debt to equity, because a trade-off is between debt and equity. So proportion of debt to equity, that is the financial leverage. Okay. Then tell me, what the debt holders get? They get interest. What the equity holder gets? They
Dividend.
get dividend and also
Dividend.
capital appreciation. Capital appreciation also. So now looking into their expectation, again I'll have to see what kind of proportion I should have. Tell me, debt should be more or equity should be more? Or no decision can be made, it depends. What is your answer? Tell.
Sir, equity should be more.
Why?
So because the ratio will come less.
But are you managing for ratio only? You are managing finally for profit. You see, let the debt be 100%. If I am making profit, I'll be happy. True or not? If let the equity be 100%. If I am making profit, I should be happy. Making profit means not profit only. Higher profit I am making, then I should be happy. Who can tell? Debt and equity. Which one I should be more?
So it depends on the interest of debt and on the dividend percentage.
Correct. So you are telling why debt? Expectation of the debt holder. So you are telling interest is? Oh, but that is an issue. So you are the CFO of a company. You are appointed for that purpose only, to manage all cumbersome process. What is the financial dynamics? Okay, I am explaining you. Suppose you see what you have answered it correct. It is depends. Why it depends? Suppose I make higher debt. What will happen? Let us see. Suppose my interest rate is 8%. My return on asset is 15%. So how much I am getting extra?
7%.
7%. So who gets this 7%? Where it goes? This 7%, either you pay it as dividend or you keep in the company as retained earnings. Retained earnings will provide growth to your company, because then money will invest and you will earn further. True or not?
Yes, sir.
So this growth, if it grows, what will happen? Share price of the company will go up. Who will get the money? Shareholders will get the money. Correct. So what for you are working? You are the CFO of a company. Whom for you are working? You are working for the shareholders. So what do you will expect? You will tell, okay, let the debt be more. Got it or not?
Sir, but if profit will be less?
That's why we told it depends. We'll come to that situation. So could you get it? The dynamics that I am explaining?
Yes, sir.
Yes, sir.
Now you see, when your debt is more, it is called a levered farm. Never miss this word. Many times people will be asking you question in the interview that suppose in a levered farm it happens like that. At least you must be able to understand that a levered farm means debt is more than the equity or higher debt.
Sir,
Now,
what is the one thing? What is the formula for the financial leverage?
it is debt by equity. So you can change in financial leverage also. You have got change in debt and change in equity. Okay. Why you are asking?
There a confusion. It's over. Yes, sir.
So primary, you see, I am just telling you the primary things. You have got extensions also. You have got multiple definitions also. Simple things I am explaining you just to give you the concept. Because we don't have, you see, otherwise we should have done problems on this thing. Again, in different situations, what will happen, but I am not going into detail because we don't have too much time in hand. Okay. So debt by equity is your financial leverage. Okay. So could you get it? What is a levered farm and why a company should be levered? Because if your return ROA is more than your interest rate, you get the net differential 7%, which will again be contributing the shareholder. The CFO is working for the shareholders' interest. So he will try to increase the amount of debt in the company. So you know, in 1965, Reliance started with 50,000 rupees only. What is the market capitalization now? 10 lakh crores. No, it or not? How it has grown? It has grown only through debt. Not only through debt, primarily through debt. It has increased. It has gone up so high. Got it? True. But you see, here it is a little bit different. Here, too much of debt is also not good, you know, because insolvency will, there is a insolvency cost. If you cannot manage your debt, you see, here suppose the profit percentage is 8% to 15%, I have written. Instead, it is 8% and this one is suppose 9%. You are getting a differential of 1%. Tell me, are you in a safe zone? Little bit of variations and turmoil in the economy will eat away your profit and you will be, in short period of time, you will be bankrupt. So these are the parameters which will decide. how much debt. But usually you see, no company goes beyond a debt level of 4:1. That means equity 1 for debt 4. If it is going beyond that, that means you can find that it is risky. So you have got another analysis, the Altman analysis, which also tells that how much you should have. Bankruptcy cost is there. That is another ratio which will explain it. But you see, for now you understand 4:1. Nobody goes beyond that. And again, you see, could you get it, the dynamics, why the levered company can have higher profit? Tell me, in India, company more prefer debt, or in Western countries, companies prefer more debt? Just common sense?
In India.
No. Do you know what's the reason? Suppose in our country, just in reality, I am telling you, your interest rate, term loan interest rate is 12%. When Western countries, it will be as low as, you see, in Japan, it is negative. And in US and other, it will not go beyond 5%. So you see, 12% you are paying. They are, that means you are paying. In Western countries, companies are paying 5% only. Is it not easy to cover this 5%? Getting me?
Yes, sir.
You can comfortably cover this 5% with 7% profit. But 12% means you will have to go beyond this one. Then only you can make profit. So in present trend in India, you know, whichever company has taken huge debt in present times. So you see, Reliance is a rare example which has successfully managed, and it was before, since last 10 years, you know, Reliance is not making, its share price is not going up too high. Reason being, again, ROA, they cannot keep on making the same ROA years together, because now competition has come. Are you getting me? But in those period, what is the period? The period was from 80s to say 2005. During this period, Reliance grew like anything by using its leverage. Presently, you see, many companies are insolvent because they have taken huge debt. Why? Competition has come, liberalization has come. You cannot command higher price. Without higher price, you cannot have more profit. So ROI cannot justify your interest that you are paying. So you become bankrupt. Got it? Got it or not?
Yes, sir.
Beyond that, you see, which other factor will decide how much debt you take? You see, again, you have got expansion facilities. If you don't have growth facilities, why you should take debt? Example is FMCG companies. They don't take a huge amount of debt because they don't have a lot of growth potential. Are you getting me? Look into the balance sheet of your financials of Dabur, Hindustan Unilever, Procter Gamble, ITC. You will not find too much of debt. That is one parameter why you should have lesser debt. Another one is management philosophy. Companies like your Piramal Brothers and others, they have got a huge amount of cash in their hand. Whatever business they do, they keep on doing in your cash business, and they keep money with themselves to buy new business. Are getting me? Same company also at certain point of time, they may be going for leverage, high debt, they may be going for equity again. I am giving you another example. In the Reliance industry, you know, in 1980, I believe, they opened one company, Reliance Petroleum. Okay. It was Reliance, and Petroleum was not with your Reliance Industries at that time. Later on, it merged. For 15 years, this company didn't make profit. Tell me, if they would have they raised the whole amount of money through equity. Just tell me, if they would have taken debt, what would have happened? Company would have gone bankrupt. Here, what is happening? Because equity shareholders, they have issued equity. Shareholders' dividend payment is not compulsory. So you manage without dividend for 15 years, and after that, you see, once share price goes up, the shareholders get back their return. Are you getting me? You see? So you cannot define leverage is good or bad. So dynamics are like this. Got it or not? Hmm. Hmm. So every merger story is a different story. HDFC and HDFC Bank, their merger story is different. What for they are doing? They are doing for administrative efficiency. Okay. Because both are for the same parent. If they come together, lesser number of people and lesser transport cost, or you can say lesser number of office space, can manage the business easily. True or not? This is one reason. Second, as you are asking, I am answering your question in different way. You know, one company, Tata Steel, took over Bhushan Steel.
Yes, sir.
So do you know why,
Yes,
why
sir.
they took over? Again, it is economies. Why? Because one is hardly they have got 150 kilometers away from distance between two plants. All their iron mines are in Odisha only. Majority of iron mines are in Odisha. They have taken long term for 30 years, 40 years lease. Okay. Beyond that, Bhushan Steel was at that time, it had a debt of 45,000 crores. Bankers agreed for 29,000 crores. Now tell me how much gainer they became. They didn't have to pay this much of debt. They paid up this much of debt and got the company. Who was asking? Are you getting me? Why people companies are going for mergers? If you are talking of the immediate return, so in return, what happens? Immediately after merger, usually price goes down. So after a period of time, when company consolidates well, they have their operational efficiency, their cost goes down, then price again goes up. Are you getting me? You got answer to your question or not? Tell me. So this is the dynamics of your financial leverage. So you will look into different angles, but this basic ratio, it provides you a parameter. You provide you a one kind of indicator through which you will have to manage yourself. So I think whatever I have discussed by this time more or less covers my portion of the course. True or not? First, we discuss working capital management. We discuss capital budgeting. We discuss risk return. This portion should have been addressed in detail, but I just briefly I told you the concept so that your core paper, people who are not taking your specialization paper, can at least answer in the interview that this is leverage, this is financial leverage, and this is operating leverage. Then you have got degree of leverage, you have got a combined leverage. Both if you multiply operating leverage with financial leverage, that gives you a combined leverage. Leverage primarily is the balance between these two, fixed cost and variable cost, and cost, debt, and equity. Okay. So we don't have time. That's why I could not elaborate it much in detail. Two sessions which would have taken for this thing. So my portion with this thing is over. Section C, I don't remember, but KK sir has taught you cost of capital. Tell.
No,
do
sir,
you
I don't
remember?
think so.
Sure, I'll let me see the mail. He has written me where he has left the cost of capital. Just allow me 2 minutes time. Section C, section C not covered. Okay. So again, briefly, I will tell you the concept also, because this may be easy. Remember, whatever you are studying in CF, 80% of your questions will be from this area only. In the interview, I'm talking of interview. For coming 5 years or 6 years time, if you are in the area of finance, questions will be in from this area only. Even if you are in the area of HR or marketing, people will be primarily asking questions from this one. What is capital budgeting? How do you do the working capital management? What is leverage? What is cost of capital? Are you getting? So, although I am not asking questions from this area, but never miss this thing from your mind. This will be useful for your future. Okay. Okay. So, what is capital? How do you explain capital? That's true. But I am a layman. I don't know what is asset, what is liability. No, that's fine.
Sir, capital
That's
is a fund by
fine.
capital is a fund by using which a company earns profit.
Okay. Fine. But other way, both of you answered correctly. I'm not telling it is wrong. I am telling in a layman's term, what is capital? Anybody else? I'm expecting a specific word.
So can we say that the amount we invest in any asset to get